Hey everyone, welcome back to Corporate Decoder, the place where we unpack the numbers behind the headlines and prepare for the next big move from analog devices. In this case, it looks like the future is bright, but let's dive into the numbers to see if that's really true. In this report covering the 3 and 9 months ending August 2nd of 2025, analog devices is showing some really strong growth. The company's total revenue shot up by 25% for the 3-month period compared to last year, bringing in over $2.8 billion. And for the 9-month period, it increased by 14% to almost $8 billion. This strong performance is happening across the board, with demand increasing in most of their key markets. So let's break down where this money is coming from. Industrial sales are up a significant 23% for the 3-month period and 9% for the 9-month period. Automotive sales saw a solid 22% jump in the 3-month period, and a 14% increase for the 9 months. Consumer markets experienced a 21% rise in the short term and a healthy 24% in the longer term. Communications also saw a good boost with 40% and 22% increases respectively. This growth shows analog devices is a key player in many essential tech sectors. Now, what about how much money they're actually making after all their costs? The gross margin percentage jumped to 62.1% in the 3-month period, up from 56.8% last year, and it's 60.8% for the 9 months, up from 56.8%. This means they are keeping more of every dollar they earn. This improvement is attributed to better use of their factories and a slight decrease in the cost tied to previous company acquisitions. To stay ahead, analog devices is investing heavily in research and development, even with higher expenses tied to employee compensation and benefits. Their R&D spending as a percentage of revenue remains steady at 16%. This suggests they are committed to innovation, which is crucial for staying competitive in the fast-paced semiconductor industry. Similarly, their selling, marketing, general and administrative expenses also saw an increase, mainly due to higher employee compensation similar to R&D. However, these costs as a percentage of revenue stayed consistent at 11%, indicating efficient management of these operational costs. The amortization of intangibles, the cost of certain acquired assets spread over time, actually decreased slightly. This is good news because it means less of their revenue is being used up by these past acquisition costs. They did incur some special charges, primarily related to their global repositioning actions and a facility sale, but these were down significantly in the 3-month period compared to the prior year, although they increased on a 9-month basis due to charges taken earlier in the year. These charges are part of their restructuring efforts to streamline operations. Looking at their non-operating items like interest expense and income, there was a decrease in expenses for both the 3 and 9-month periods. This was largely due to lower foreign currency expenses and reduced interest payments on their debt. Now, this is an interesting one. The provision for income taxes and their effective tax rate saw a significant jump, especially in the 9-month period. This is mainly because of a recent tax law change, the OBBBA, which resulted in a substantial one-time deferred tax expense. This definitely impacts their net income figures. Because of these factors, their net income for the 3 months ended August 2nd was $518.5 million, a 32% increase from last year, and for the 9 months it was $1.48 billion, up 28%. This strong net income growth, even with the tax impact, highlights the company's solid operational performance. Their cash flow from operations is also very robust, showing over $3.1 billion for the 9-month period. This means they are generating a lot of cash from their core business activities. In investing activities, they spent over $1 billion in the 9-month period. This was mainly due to investments in short-term financial products and capital expenditures for things like updating their manufacturing facilities. However, they did see some proceeds from selling property, which helped offset some of these costs. On the financing side, they used over $1.6 billion in the 9-month period. This was driven by increased share repurchases and higher dividend payments to shareholders, showing a commitment to returning value to investors. Let's talk about their working capital. Accounts receivable increased, highlighting strong sales, but also the timing of customer payments. Inventory levels also went up, which is typical as they prepare for anticipated demand and manage their production cycles. Analog Devices has quite a bit of debt, totaling over $8.7 billion. They recently issued new senior notes in April and June of 2025, extending their debt maturities. However, with a strong credit rating and healthy cash flow, they seem to be managing this debt effectively. They also have a commercial paper program for short-term borrowing, and they actually increased the limit on this program in August, which signals confidence in their ability to manage short-term liquidity needs. The company is actively repurchasing its own stock with over $10 billion still available under its authorized program. This often signals that management believes the stock is undervalued and it can boost earnings per share. It's also worth noting that Vincent Roche, their CEO and chair, terminated a stock selling plan and then adopted a new one. This is common for executives to diversify their holdings, and it's done under specific rules to avoid insider trading concerns. Finally, the company has provided the required certifications from its CEO and CFO confirming the accuracy of their financial reporting. This is standard procedure for public companies and reinforces the reliability of the information presented. So what's my take on all of this? Well, Analog Devices is showing impressive growth and profitability. Their strategy of heavy R&D investment and active shareholder returns seems to be paying off. The increase in gross margin is particularly strong and suggests excellent operational efficiency. The significant tax expense related to the OBBA is a one-time event and shouldn't distract from the underlying business strength. While their debt load is substantial, their strong cash flow and credit position suggest they can manage it. The move to increase their commercial paper program and continued stock buyback signal confidence from within the company. What do you think about Analog Devices' performance? Let me know in the comments below. If you found this breakdown helpful, smash that like button and subscribe to Corporate Decoder for more breakdowns just like this. And don't forget to join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and we'll see you in the next one.